Most people think the best time to invest in property is when the market is booming. Prices are flying, everyone's making money, confidence is high. But what if I told you that's actually when many average investors make their worst decisions? Because the truth is, some of the smartest investors build the most wealth when the market softens, not when it's hot. And in this video, I'm going to explain exactly why stock markets can create the biggest opportunities and why waiting for certainty might actually cost you hundreds of thousands. And stick around because later in the video, I'm going to show you a real world example of two investors buying the exact type of property, one in a booming market and one in a softening market. And why the second investor came out massively ahead despite buying when sentiment was negative. Let's address the elephant in the room. Every time the market softens, every time interest rates rise, every time media headlines start screaming things like property downturn incoming, buyer confidence weakens, investors sit on the sidelines, people panic, and suddenly everyone starts saying, maybe I should wait. Maybe prices will drop further. Maybe now's not the right time. But here's the irony. The exact moment average people get scared is often the exact moment experienced investors start leaning in. Because seasoned investors understand something most people don't. You make your money when you buy, not when you sell. And the softer markets can create the perfect buy condition if you know what you're doing. Now, before we dive in, that doesn't mean every soft market is automatically good. And it definitely does not mean buying rubbish property just because prices have cooled. But if you understand strategy, if you understand timing, if you understand negotiation, a softening market can be one of the best environments to build long-term wealth. Let me explain why. First reason, less competition. One of the biggest killers of investment returns in hot markets is emotional overpaying. When the market is booming, what happens? Everyone jumps in. First-time buyers panic, upgraders panic, investors panic, and suddenly every open home looks like this. 20 groups through, 10 offers submitted, bidding wars at auction, property selling 50 grand over reserve, 100 grand over reserve. And what happens? People stop buying logically. They buy emotionally. They stretch their budgets, they overbid, they waive conditions, they compromise on fundamentals because FOMO takes over. But in a softening market, that madness disappears. Suddenly, there are few buyers, less urgency, less emotional competition. And that means you leverage. You can negotiate harder. You can add clauses. You can do due diligence properly, and you can walk away without any pressure. That alone can save you tens of thousands upfront, because sometimes the best return you ever make is a discount you secure on the purchase. Second reason, soft markets allow you to buy better properties. See, when the markets run hot, people become desperate just to get in, and they start buying average assets, bad locations, poor floor plans, tiny land sizes, compromised fundamentals. Why? Because they've been priced out of quality. But when the market softens, premium stock becomes more accessible. Suddenly, that suburb that was out of reach, maybe now it's just attainable. That property that had 15 offers last year, well, now maybe it's sitting for 30 days. That seller who went budget price, well, now they're negotiable. And that matters because in property, your money is made in asset selection, not just being in the market. A soft market often lets disciplined investors upgrade the quality of the asset they buy. And over a 10-year hold, that better quality asset can dramatically perform. Third reason, sellers become realistic. In boom markets, sellers think their property is worth gold. Everyone thinks they've got the best house on the street. Everyone expects record prices. Everyone just wants one more offer. But when that market softens, reality kicks in. Motivation appears. Suddenly, sellers need to transact because maybe they've bought elsewhere. They're divorcing, they're relocating, they're under financial pressure. They've held too long with their offers, and motivated sellers can create opportunity because property wealth isn't built from buying average deals at retail. It's built from buying strategically, sometimes under market, sometimes with favorable terms, sometimes from people who need certainty more than top dollar. Softened markets produce more of these opportunities. Now, here's why many investors get this wrong. They assume if price growth slows, the market must be bad. Wrong. Because investors don't just make money from capital growth, they also make money from cash flow. And many softening purchase markets still have incredibly tight rental conditions. Rental markets in many Australian areas remain firm despite affordability pressures. Meaning, even if buyer demand cools temporarily, rental demand should remain extremely strong. Why? Because when rates rise, affordability tightens, more people rent longer. Fewer people can buy, tenant demand increases. So smart investors often secure better purchase prices plus strong rental yields. And that's a very attractive combination. Because if you can buy well and hold comfortably, you can ride out temporary market softness while waiting for the next upswing. So quick pause. If you're getting value from this video and you enjoy content that breaks down property investing logically instead of emotionally, make sure you hit the like, subscribe, and drop a comment below. Would you buy in a softening market or are you going to wait? I'm genuinely curious where people sit on this. Now, let's get into the biggest mistake people make, because this is where most investors lose. Waiting. Here's a trap. People think, I will just wait until the market bottoms. Sounds logical, right? Except almost nobody times the bottom correctly. Why is that? Because markets don't ring a bell when they hit rock bottom. There's no announcement, no email from the government saying, congratulations, everyone. Today is the lowest point, buy now. By the time the media says the market has recovered, it already has. By the time confidence returns, prices have already moved. By the time people feel stable, opportunity is gone. And history shows Australian property markets often remain supported by structural undersupply and tight listings, even when momentum slows. Most people buy after confidence returns, which usually means they buy after growth has started. And that's expensive. Let me show you exactly what I mean. So imagine two investors. Investor A buys in a booming market. They panic, competition's fierce, they overpay by 40 grand because of bidding wars. Their profit grows 10% in 1 year. Looks great, right? Now, investor B buys in a softening market. They negotiate strongly, secure better property, they buy $40,000 under the comparable market value. Growth is flat for the first year. Now, fast forward 5 years. Both properties average 6% annual growth after that. Who wins? Investor B. And why is that? Because they started from a lower base. They bought smarter, they didn't overpay, they secured margin upfront, and that's the hidden power of buying well. Too many people obsess over short-term growth, and they ignore purchase discipline. So what's the big lesson here? Here's the truth most people need to hear. You don't need to buy at an absolute bottom to build wealth. You just need to buy a quality asset at a fair or strategic price in a fundamentally strong location and hold long enough. That's it. Trying to perfect time in the market is a fool's game, because long-term wealth isn't built from perfect timing. It's built from time in the market, not timing the market. And right now, Australia isn't one single market anyway. Different regions are moving at different speeds, with some markets slowing down while others remain strong. Some suburbs are booming, some are plateauing, some are correcting, some are quietly building momentum. That's why sophisticated investors don't ask, is the market good or bad? What they ask is, which market, which suburb, which type of asset? Because opportunity always exists somewhere, even when the headlines are negative. So if you're still waiting, wait for the perfect conditions, waiting for rates to drop, waiting for confidence to return, waiting for certainty, ask yourself this. What if the waiting is actually costing you more than acting strategically? Because the reality is, softening markets can offer less competition, better negotiation, better asset selection, more motivated sellers, strong rental demand, and lower emotional buyer pressure. That's not something to fear. That's something smart investors prepare for. If you're someone who knows that you want to invest, but you're unsure where the opportunities in the market actually are, or you're worried about making the wrong move, that's exactly what we help our clients with every day. We help Australians build strategic property portfolios based on data, cash flow, your borrowing power, long-term growth strategy, not hype. So if you want help building your investment strategy in today's market, click the link below, book in a strategy with the team. We'll help you understand where you are at, what your borrowing power looks like, and what your smartest next step would be for your goals. Because the right market isn't always the hottest market. Sometimes it's the market everyone else is too scared to buy in. And that's where smart investors win. We'll see you in the next video.